Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 25th, 2026. I hope you're doing well. I hope you're having a nice weekend. I hope you had a good trading week, and I hope you are going to find this podcast today helpful. The format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all of my trades, all the positions that I have. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluences were of why I entered the trade, how I position size based upon the current market volatility of that particular stock. We're going to talk about how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the stock moves in the direction that I would like it to, what happens when I get to trailing stop level, and then how I ultimately exit the trade if it gets to overbought levels. So I hope you're going to find that helpful. Basically, when I entered the trade, why I entered the trade, and really most importantly, how I am going to manage the trade going forward. It's always important in trading that you have a plan, and more importantly, that you follow the plan. You know, I have a systematic approach to trading. So it's by the numbers. If it does this, I'm going to do that. If it does that, I'm going to do this. And in my 30 plus years of trading, in my opinion, in my experience, it's the best way to be a profitable trader. So I'm just going to share with you how I do it. Hopefully it's helpful. After that, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and then to follow it. You can have the best plan in the world, but if you don't follow it, it's worthless. So, you have to find a trading approach that fits your personality. That is quite important. And then by all means, follow it. And really what it comes down to is getting out of losing trades quickly and staying in winning trades, being very impatient with losing trades and being very patient with winning trades, and having a process that tells you what to do so that your emotions don't run the show, your plan runs the show. So after we talk about trader psychology, I did go down through my watch list last night, and I went down through each symbol one by one, and I have identified some potential setups for next week that I'll share with you. Now, these are not where they need to be yet, but they're within striking distance. And when I say striking distance, they're within striking distance of a confluence of support levels, whether those are major moving averages, order blocks, RSI levels, double bottom bullish divergences, and ideally all of these happening together. So I have identified 7 of them. And after we get through the podcast, towards the end of the podcast, I will show you what I'm looking for. I will show you what kind of reactions I would need in order to be able to initiate a position. All right, so I hope today's podcast is going to be helpful. If it is, I really would appreciate if you could just take a quick second, hit the thumbs up button. It really does make a difference. It lets YouTube know that there's some valuable content here, and so they can share it with more people. So, all right, well, let's run the U.S. legal disclaimer, get that out of the way, and then we'll come back and we'll get started. So hang tight for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. So first position that I am currently in is NVDA. I did enter NVIDIA here on the 7th of July at 196.93. You can see it's been a pretty good trade so far. But the reason that I took this trade was twofold. You see this green box here. This is called an order block. And order blocks are a very important part of my trading. I use them in a high percentage of my trades. And this order block was something that happened in the past. And in just a moment, we'll go back and I'll describe what formed that order block. But the reason that I took the trade here on the 7th was the previous day we closed under the order block, below the order block, and the day when I entered the trade, it closed back in it. That is called the rejection of the bottom of the order block. We also had a V1 entry signal here. V1 consists of two bars, bar 1, bar 2. Bar 2 goes below or washes out bar 1's low, and then it closed back above bar 1's close. That's a V1. I also use something called the V2, and if you'd like to learn more about V1s, V2s, I have a YouTube video on it. You can check it, and it's a really good video. And I use V1s and V2s in my trading all the time. So we had a rejection of the bottom of the order block, and we had a V1. So like I said, this order block happened in the past. So let's go back to when it happened. And the order block is this bar here on May 5th of 2026. So these order blocks are key levels that happen in the past where the market comes back down to them. I really like to look at those and consider them as smart money areas. But we need a certain pattern to happen before an order block happens or is formed. So to start with, to look for an order block, I need to find a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right, like right here. So swing low. After the swing low, we need what is called a swing high. Now, swing high is just the opposite of a swing low. It has a lower high to the left and a lower high to the right. So we have two of what we need. We have a swing low followed by a swing high. Now, the next thing we need is we need another swing low. Swing low to the left, swing low to the right. But the important thing about this swing low, it has to be lower than the first swing low. So we have a swing low, we have a swing high, we have a lower swing low. Now, the very next thing we need is we need the price to go above the first swing high. And here is the swing high. And that happened here on the 8th of May. So swing low, swing high, lower swing low, and then the price moved above the swing high. As soon as that happens, I consider that to be a market structure change. And when market structure changes, I take the lowest closing bar prior to the market structure change, and that is my order block. This is the high and the low of the order block. So as you can see, when we broke structure to the upside and we moved up here, now in hindsight, looking back at this order block, was this smart money? Well, of course it was, right? In hindsight, it's very easy to see when it's way up here that this was smart money prior. We didn't know what was going to happen, but after the fact, you can tell it was smart money. So the idea is taking this smart money area, bringing it into the future, and if and when the price comes back to the smart money area, the idea is if it was smart money once, will it be smart money again? Not necessarily. Things change, but more times than not, it is smart money again. You can see once we got back to the smart money here, we had a nice little bounce here for over a week, but then we came back. So, but I'm keying off of this smart money area. So I'm bringing this smart money area into the future, and this will explain more of why I got into the trade. Okay, so I identified the order block from the past, brought it into the future. Now, when I get into trades using order blocks, I can do it in multiple ways. I can get in with the rejection of the high of the order block. I can get in with the rejection of the low of the order block, like I did on the entry. I can get in with the rejection of a major moving inside of the order block, or I can put my own custom level in there. And you'll see tonight, or today, that some of the entry lines that I had were custom levels. But this one was pretty simple. It's just that the market closed below the order block the previous day. On the day that I entered, it closed back in the order block. So pretty simple. So now that I have decided I'm going to take the trade, the first thing I have to decide, and really one of the most important things in trading, is how many shares am I going to buy, right? There's all sorts of different options, but the formula that I use is good. It's conservative. I've used it for over 30 years, and it has two inputs. The first input is how much do I have in my account? Let's just say I have $100,000 in my account. I simply take 1% of however much I have in the account, and that is going to be my maximum risk on this trade. So if I have 100,000, 1% is 1,000. If I have 200,000, 1% is 2,000. If I have 50,000, 1% is 500, right? So 1% of however my total capital, that's going to be my maximum allowed loss on this trade. So 1% of 100,000 is $1,000. Now, I look over to the value of the 2 ATR. Basically, the 2 ATR is telling me how much volatility is in the market, how much movement is going on with this particular stock. And so the value of the 2 ATR at the moment is 1408. And I simply take my maximum allowed loss, $1,000, divided by the value of the 2 ATR divided by 1408. This is telling me, based upon the current market volatility that I have, this particular market has, and my account size and my maximum allowed loss, I should buy 71 shares. So boom, I buy 71 shares here at 196.93. Okay, I go ahead, I place the trade. The very first thing I do after I enter the trade is I take my entry price minus the value of the 2 ATR, which is 1408, and I place my emergency stop 2 ATRs below. If I have 71 shares and it moves $14.08 to the downside, I have lost the $1,000, right? That's my maximum allowed loss. Now, the good news is that it does not hit the emergency stop very often, only about 5% of the time. Although I will show you later, I did hit an emergency stop, so it certainly happens. And on that particular stock, yes, I lost 1% of my account because I did the math. But the good news is this does not happen very often. 95% of the time, if I have a loss, it is not going to be because it hit my emergency stop. It's going to be a much smaller loss because it's going to hit my end of bar stop. And my end of bar stop on this trade is simply a close below the order block. That will show me I took the trade because it went into the order block. If it closes below, I'm simply going to get out. But the bottom of this order block is much closer to my entry than the emergency stop. So not 5% of the time, yes, I'm going to lose 1% of my account. The other 95% of the time, it's going to be lower or dramatically lower than 1%. Maybe it'll be 0.15, 0.2, 0.25%, right? That's okay. Small losses are okay. As a matter of fact, the 1% loss is fine, although it's only going to happen 5% of the time, right? So, okay, so rejection of the bottom of the order block plus a V1, I position sized, dividing my maximum allowed loss by the value of the 2 ATR. I place my emergency stop 2 ATRs below so that if it does get there and I've hit my maximum allowed loss, my end of bar stop is a close below the low of the order block, which I'm pretty close to anyway. So I want to have these good risk to rewards. I want to be as close as I can to where I have to get out, so that if I have to get out, more likely than not, it will be a smaller trade, a smaller loss. So the next thing I do is I look to the value of the 1.5 ATR. Right now it is $10.56. Once I place my emergency stop and I know where my end of bar stop is, I take my entry price plus this value and I place an orange line above. This is what is called my trailing stop mode. If I get into the trade and it moves to this level, now I'm in a different mode. Now I'm in trailing stop mode. And all that trailing stop mode means is that once I reach that threshold in the future, if I have a close below a previous bar's low, I am going to exit half. So in trading, once you get into a trade and it starts moving nicely your way, you've probably heard you want to kind of tighten everything up. You want to move your stops up. And that is true because you don't want to give it all back. Now, I don't physically move my stops up, but I sell half when it closes below a previous bar's low after reaching trailing stop level. And by selling half, it just has the same effect of moving everything up because I've taken half off. So hope that makes sense. So, all right. So everything we've talked about so far as the emergency stop, the end of bar stop, trailing stop mode, these are all defensive moves. So in other words, if I'm in this trade and it moves against me, I have to take action. I have to get out at my emergency stop. I have to get out with the end of bar stop. I have to get out with the close below a previous bar's low after reaching trailing stop level. I'm defensively taking action, which is fine. But, you know, just like any good sports team, you can't just play defense. You have to have offense too. And offense for me is very important in trading. And the way that I play offense is I take a partial profit if today's moved a certain amount from yesterday's close. Not all, but I sell into strength. So let me give you an example. I'm still in NVDA. Let me give you an example of what I'm going to do for Monday. I simply take today's close, which is 206.84, 206.84, and I add the value of the 0.45 to it. Right now, the value of the 0.45 is $3.17. So I take the closing price, this is for Monday, 206.84 plus 317. Oops. 206.84 plus 317. My first profit target for Monday is $210.01. So let's put it up here, 210.01. That is my first profit target for Monday right here. And if it gets there, the question is, how much do I take off? It's really simple. 10% of however many shares I go into the day with. If I go into the day with 100 shares, I'm going to take off 10 at that first profit target. But I don't just place one profit target, I place 3. So the first profit target, closing price plus the value of the 0.45 ATR equals 210.01. To get my second profit target, I take the first profit target, 210.01, and I simply add the 0.45 to it again, plus 317. My second profit target for Monday, 213.18. And again, if I reach this level, I will take another 10% off, right? So if I go into the day with 70 shares, I take off 7 here, take off 7 here. Now I place a third one, and I simply take the value of the second profit target, 213.18 plus 317. My third profit target for Monday, and Monday only, these change every day, is 216.35. All right, there we go. Those are my 3 profit targets for Monday. Now, Monday, if it goes down, I may not hit any profit targets, and I have to recalculate from the next day's close. But if it moves up nicely and I hit a profit target, great. I reduce my position size. I lock in that profit. The market can't take it away from me. There's lots of advantages to take partial profits into strength. If I have a really great day, maybe I hit 2. If I hit 2, that's a great day, right? A superior, wonderful day, 3 ATRs. I've hit 6 and 7 ATR profit targets before, on really big days. But it's just a way to sell into strength, reduce your position size. If you reduce your position size, you're reducing your overall stress in the trade. And the less stress, the more likely you are to follow your process, which is very important. So those are the basics. Let's just start from the beginning here. I entered on the 7th of July at 196.93, rejection of the bottom of the order block, plus a V1. I position size properly by taking 1%, dividing by the value of the 2 ATR. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I place my 1.5 ATR trailing stop below or above, and away we go. Next day, great start to the trade, moved up really strongly, hit a couple profit targets into this strength. Next day, didn't do much, was down a little bit. Next day, up again, very strong, hit multiple profit targets into that strength. And I also got to trailing stop levels. Doesn't mean I do anything. It just means now I'm in trailing stop mode in the future. Next day went down, but did not close below previous bar's low, so there was nothing for me to do. Next day up again, very strong. Profit targets into that. Next day up a little bit, but not enough. Next day down, but did not close below previous bar's low. And then here on the 17th of July, I had my first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the remaining shares that I have. Okay. Next day up again, had a profit target there. Next day up again, profit targets. Next day up again, very strong. Profit targets into that. And then the last couple days have been down. So steady as she goes. If it continues to move up, I'll continue to hit profit targets. If it moves down and closes below the low of this order block, well, that's my stop. I'll have to get out, but you can see that if that happens, I'm very glad I took some offensive movement and sold into this strength. So this particular trade, the NVIDIA trade, the remaining shares that I have, doing quite nicely, up 4.83%. Okay, CRM. So I just got done telling you about how I place emergency stop, end of bar stops, take partial profits, trailing stop mode. And the majority of all of my trades, that's exactly how I manage the trade. But there is one exception where I manage the trade a little bit differently, and CRM is one of these exceptions. So let me bring your attention to this highlighted blue bar. This highlighted blue bar is what is called an abandoned baby. An abandoned baby happens when you have a gap down. So here from the 18th to the 19th, we gap down overnight. That is bearish. However, the very next day after gapping down, we gapped up. That was a sudden change in sentiment. What did I do? Oh my goodness. Hold on one sec. My glasses. Hold on. That was interesting. My glasses broke. I didn't do anything. They just like basically fell off my face and I couldn't see. I could see out of one eye. Anyway, I got another pair. So sorry, back to CRM. So the highlighted blue bar, we have a gap down followed by a gap up. This indicates a sudden change in sentiment from bearish to bullish, and this indicates that more times than not in the future, you are going to be higher, which actually really happened. So now, when these abandoned babies happen, I generally don't buy them right when they happen. I wait for a bit of a pullback, and that's what I did here on the 25th of June. And the reason that I waited and decided to enter the position on this particular day at 150.10 was because for one, it pulled back. For two, it rejected the negative third Keltner channel, and it basically bounced at the 30 RSI, which is a deep dip buy signal. So that is why I entered the trade. Now, the big part of this trade was that we do have the abandoned baby. And like I said, more times than not, when you have an abandoned baby, especially at these lower levels, you do get a bounce, and you can see that's what happened. So when I entered here, this is the only trade where I position size and I place my 2 ATR stop below, like I do on all trades. But the difference is, as far as I don't take partial profits, I don't have a trailing stop mode, I place a 2 ATR stop and I place a 4 ATR profit target. And I just let the trade go. I'm either eventually, for sure, I can say this for certainty, at one point in the future, we're either going to hit this 2 ATR stop, in which case I'll lose 1%, or we will hit the 4 ATR profit target, in which case I will make 2%. So I'm risking 1% to make 2% based upon a setup that more times than not will make me 2% and lose 1%. So it's all about risk to reward ratio. So you can see it started off great, really started off great. We had a little bit of pullback and we moved up. Of course, the market this week was down. The tech and Salesforce kind of went down with it. So this is more of a position trade where I don't have to be very active with it. I'm either going to lose 1% of my account or I'm going to make 2% of my account, and I just let it go. So this particular trade at the moment, doing pretty good. up 8.19%. The cues. Okay, so so far I've talked about bullish order blocks, which is the green box down here. But there is such a thing called a bearish order block. And the bearish order block I've highlighted in red. Now, the bullish order block, we need a swing low, followed by a swing high, followed by a lower swing low, and market structure change to the upside, and then I wait for the pullback to buy. This is just the opposite. This starts with the swing high, followed by a swing low, followed by a higher swing high, and then the price needs to come down and take out that swing low. Once that happens and we change market structure to the downside, I am waiting for a check back or a move back up into the bearish order block, which is the highest closing bar before market structure change to the downside. So I saw the market structure change, but I'm waiting for a check back into the bearish order block. I got short here, the cues 737.77. Now, why did I take the trade on this particular day? For two reasons. One, we rejected the bottom of the order block. In other words, we went in the order block and it was weak. It wasn't strong enough to stay in the order block and close below it. So that was my first sign that I wanted to get short. The second sign is that I just talked to you about V1s, V2s. Well, I have a V1, but this time to the downside. I have a high, bar 1, bar 2 goes above bar 1's high, but closes below bar 1's close. That is a bearish pattern. And so the confluence is a rejection of the bottom of the bearish order block plus the bearish V1. So I got short here, 737.77. Now, I position size like I normally do for a 1% loss. I place my 2 ATR emergency stop up 2 ATRs above so that if it went up there, I position size so that I would only lose 1%. But on this particular trade, the end of bar stop for me is this red line here, 739.70. And this is halfway of the number 2 bar of the V1. This is a key resistance level, halfway of the washout bar. If it were to close above 739.70, I would simply have gotten out of the trade. Now, I got in at 737.77, so I had a very good initial risk to reward ratio. So I got short here, 737. I placed my 1.5 ATR trailing stop level below. The next day, the market really went down. I hit multiple profit targets where I locked in part of that short position on the big move down. On the very first day, I got to trailing stop mode, which now, because I'm short, means that if I have a close above a previous bar's high, I'm going to get out of half. Well, the next day did go down again, where I took another profit target to the downside. It recovered a little bit. Next day, we had a big gap up, but by the end of the day, it did not close above the previous bar's high, so I stayed in the trade. The next day was down again, hit another profit target into that. And then here on the 29th was our first close above a previous bar's high after reaching trailing stop level, again, because I'm short, and I locked in a gain of 1.95% on the remaining shares. Next day, we had a huge move up. I thought, I think this may close above my line in the sand there at 739.70, but it did not, so I kept the entire trade. The next day moved down, took profit targets into that move down. Next day moved down again, took profit targets into that move down. Next day was up, but didn't close above the previous bar's high. Next day down, more profit targets. Then we had a little bit of a rally. Here we had a profit target from the 10th to the 13th. Couple days sideways, and then we really went down, profit target, really went down, profit target, and we had a few day rally. But of course, the last 2 days the markets have come down dramatically, at least the NASDAQ has. And so I hit another profit target on those days. So the remaining shares that I have on this particular trade doing quite well, up 7.83% on the short position on the Qs. Microsoft, okay. So I did get long Microsoft here on the 26th of June at 373 even. You can see the green box, the order block from the past. On the day that I enter this trade, it closed back in the order block. You can see the previous day it closed below, but then it closed back in. So that's a rejection of the order block. So that is one of the reasons I took the trade. The other reason is that the previous day's RSI reading was below 30 RSI. On the day that I took the trade, it closed above 30 RSI. A close below, close above the 30 RSI is a legitimate deep dip by signal, but what makes it more important is that both of these happen at the same time. We closed below 30, closed above 30, which by itself is legit, but we also closed below the order block, closed above the order block. So that's the confluence, everybody. That's what I'm looking for. Confluences. The more confluences that I have, the more likely I'm going to have a profitable trade. In addition to that, we talked about V1s, but we have a V2 here. A V2 consists of 3 bars, bar 1, bar 2, and bar 3. Bar 2 has to go below bar 1's low. Bar 3 has to close above bar 1's close. This is not a primary signal. I would have not have taken the trade just because I had a V2, but I had two primary signals. I had a rejection of the bottom of the order block, and I had a rejection of the 30 RSI, and I had a V2. So that's just cherry on the top of the cake. And so I entered here 373 even. I position size for a 1% loss of my account at the 2 ATR. My end of bar stop is simply a close back under the order block. Place my trailing stop level 1.5 ATRs above, and here we go. Next day it was up a little bit, but closed lower. But you can see during the day it went below the order block. Had it closed there, I would have had to have gotten out, but it closed back in, kept me in the trade. Next day was up a little. Next day up very nicely, hit profit targets into that strength up. Next day up again, profit targets. Next day down a little bit. Next day up, hit a profit target at the top, but this did get to trailing stop level on this day, so now I'm in trailing stop mode. The next day, first closing bar, below a previous bar's low after reaching trailing stop level. What did my rules say? Take off half. And I did take off half for a gain of 2.75%. Next day, we gap lower, reverse back up higher. Next day, profit target. Couple days sideways. Next day, profit target. Next day, profit target. And then we've kind of moved sideways from there. And over the last few days, of course, we have moved down. But you know, I did take some profits up here. I did take some profits here, which in hindsight was the right thing to do. Take a little while the market's giving it to you. So the remaining shares that I have on this position are still up 2.27%. But you can see taking the partial profits up here at much higher levels was the right thing to do. Now, earnings are coming out here on the 29th of July. So I never hold through earnings, everybody. So regardless of where this stock is, you know, even if it's way up here or if it's, you know, as long as I haven't stopped out, I will get out of this trade prior to earnings. I don't like to hold through earnings. So wherever it is, as long as I'm in the trade before earnings, I will just exit. So the remaining shares on this particular trade up 2.27%. Silver. Okay, so I talked to you about the abandoned babies on CRM. Well, I took the same trade here on silver, everybody. I did enter on silver. You can see I marked this abandoned baby in green. Why? Again, abandoned baby, you have a gap down followed by a gap up, and that's what we had. And so I entered here $50.82. I position size for a 1% loss of my account, 2 ATRs below down here. And then to the upside, I placed a 4 ATR profit target, which is equivalent to a 2% gain in my account up here. And I'm just going to let it go. Eventually, I will either hit the 2 ATR stop or I will hit the 4 ATR profit target. But the reason that I do it this way is these abandoned babies are strong signals. They don't always work, but they work more often than they don't. And I like, you know, you can have abandoned babies higher. I don't get too excited about those. If they're near the negative third ATR channel, if they're near the 30 RSI, that is really the abandoned babies that I'm interested in. So I got in 50.82, 2 ATR stop, 4 ATR profit target. I'm just going to let it go. And eventually it's going to hit one of those. Another reason why I did enter this trade also is if you look at the red MACD bars, you can see this bottom here has the deep red MACD bars. MACD bar is a momentum indicator showing that there's strong selling momentum. So we did bounce from there. MACD was able to go green, and then we came back down here more recently to where closer to where I took the trade, and we are lower here than we were at this first low. However, now at this point, we do not have any red bars. This is called the double bottom bullish divergence. And more specifically, because there are no red bars, this is called the double bottom bullish MACD divergence with a missing right shoulder. All this is saying is that the selling momentum is slowing from a MACD perspective. And if the selling momentum is slowing, what that means essentially is that you're running out of selling momentum, you're running out of sellers. And the implication, if you run out of sellers, is that you can expect a move back up. And so taking this in the aggregate, taking these together, the double bottom bullish MACD divergence with the missing right shoulder and the bullish abandoned baby is why I got in the trade. All right, so it started off pretty good. We have had a pullback, but currently this trade is up 3.44%. And again, I'm just going to let it go. I'm not managing it. It's either going to hit my 1 ATR, I'm sorry, my 2 ATR stop loss or my 4 ATR profit target. But at the moment, it's up 3.44%. IBM. All right, I took IBM here on Thursday, 7/23 at 206.65. Now, the reason that I took this trade was during the day, we went below the 30 RSI. At the end of the day, we closed above the 30 RSI. That's a simple intraday rejection of the 30 RSI, which is a deep dip buy signal. Completely legitimate. But in addition to the under 30, over 30 in the same day, we also have what is called a V1. I just mentioned that. V1 consists of two bars, bar 1, bar 2. Bar 2 goes below the low of bar 1's low, closes above bar 1's close. It's not a primary signal, but again, cherry on top, it adds bonus points to the trade. So I entered here 206.65. I placed my emergency stop 2 ATRs below. My end of bar stop on a intraday rejection of the 30 RSI is a close back below the 30 RSI in the future. So the reason I took the trade is because it went under 30 and then closed over 30. So my end of bar stop will be in the future if it closes below 30 RSI. I placed my trailing stop level 1.5 ATRs above, and you can see it did move up quite nicely today, and I did hit one profit target on the first day in the trade. Reduced my position size a little, lock that in. The market can't take it away from me. This particular trade on the first day is up 3.66%. And then TLT. I did enter TLT on Friday at the close. And again, why? Abandoned baby. I didn't highlight it here. Let me highlight it for you in blue. The previous day, we gapped down, very bearish momentum, that very bearish sentiment. Today, we gapped up. So we gapped down, followed by a quick gap up. So it's a quick change in sentiment. Then we came back down. We did hold the top of this abandoned baby, which is an important level. So I entered here 83.25, right where it closed. And again, on this particular trade, I'm doing the 2 ATR stop, the 4 ATR profit target, and I'm just letting it go. Again, with these abandoned babies, I don't get too excited about doing them when they're up here in the value zone, but when they are this low, here, this was the 5 ATR channel. We're near the 30 RSI. We're at some major oversold levels. And in addition, you can see the green box. This is an order block from the past. So I feel like there's a lot going on with this trade. Obviously, bond prices are very low. Interest rates are very high. Who knows? I don't know if this will reverse, but the ingredients are there for a reversal. The abandoned baby, the under 30, over 30, the order block, and so on. This one, I'm just going to let it go. 2 ATR profit target, 4 ATR, I'm sorry, 2 ATR stop loss, 4 ATR profit target. This particular trade, completely break even at the moment. So those are all the open trades. NVDA, the remaining shares up 4.83%. CRM, remaining shares up 8.19%. The short on Qs up 7.83%. The remaining shares on Microsoft up 2.27. Silver up 3.44. IBM remaining shares up 3.66, and then TLT just took that even. Let's go now to the close trades. So this is the example I was telling you about that I actually hit my emergency stop. I entered the trade here on the 15th of July at 97.15. This is what's called a higher low V2 entry. Remember the V2 consists of 3 bars, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Okay, so that's a V2, but the reason I took it is if you see this top green line and this bottom green line, anywhere in between these green lines is called the value zone. And when you close below the value zone, we closed below this green line, and then we moved into the value zone, and then we had a pullback with a reversal with the V2. This V2's low, this is higher than this previous swing low. So this is why it's called a higher low V2. It had to close in the value zone. So I entered here at 97.15. I placed my emergency stop 2 ATRs below. My end of bar stop on a higher low V1 or V2 is halfway of the washout bar. Well, this is the number 2 bar. This is the washout bar. 95.77 is my line in the sand. So if I have a close below that, I have to get out. You can see the trade started off great, and you can see I'm very grateful that I sold into that strength, right? I wish I would have sold it all, but obviously those are not my rules. But I did hit profit targets into the strength on the next day, which I'm very grateful because, of course, you see what happened to it. So it mitigated the loss by selling some at profitable levels. So again, just showing you why it's so important for me, at least, to sell something when the market gives it to you. So then we came back down the next day. For 3 days, we did hold that level that I was talking about. But then on Thursday, we lost it in a big way. Not only did it close under my end of bar stop, it hit my emergency stop. Right? Only happens 5% of the time, but it happened. So I did have to get out. This one hurt, loss of 4.6%. But listen, I have to get out, right? Those are the rules. And then look what it did today. Rallied right back up, which is frustrating, 100%, but it happened. So the remaining shares that I had on Disney, loss of 4.6%. Apple. All right, Apple was a really good trade. I did enter Apple back here on the 29th of June at 281.61. Why? Couple reasons. You see the order block, the green box. On the day that I took the trade, you see how it rejected the top of the order block, meaning it went in the order block during the day, but then it closed above the order block at the end of the day. That is one of the reasons I took the trade. The other reason that I took the trade is something called a megaphone trend line. A megaphone trend line is when you connect a swing low to a lower swing low. So here's the swing low, here's the swing low. We connect that trend line to the 2, and that trend line goes out into space. The idea with the megaphone trend line is if it rejects the third touch of the trend line, this is the first, this is the second. If in the future, when you have that trend line and you have that slope of the line going out to the future, if it rejects that level, that's an interesting event for me because it's showing that the market is rejecting a trend line in the future. And so this was the confluence of the trade was the rejection of the megaphone trend line and the rejection of the top of the order block. So I entered here 281.61. I placed my emergency stop 2 ATRs below. Now my end of bar stop on this one is a custom level, and you can see the green line here at 278.90. This is the custom level, and it's based upon the previous bar. This is a previous big up bar. If I have a previous big up bar, the thing about up bars is there should be some inherent Fibonacci support at halfway of that bar. And so that's why I put that level there. So this is my level. As long as it closes above this green line here at 278.90, I'm in. If it closes below, I am out. And it gives me a very good risk to reward ratio because my entry point is very close to that custom level, 278.90. Place my trailing stop level 1.5 ATRs above, and away we go. The next day, moved up. Perfect. Hit a profit target into that strike. Next day, up again. Profit target into that strike. Next day, huge day up. Hit multiple profit targets, and I got to trailing stop mode as well. Then we kind of grinded higher here, grinded higher here. I had a profit target here. Here on the 14th was our first close below a previous bar's low. After reaching trailing stop level, what did I do? I had to take half of the position off for a gain of 10.54%. Next day, up again, very strong. Glad I kept half. Sold into that strength. Next day, up again. And then here on the 20th, I exited the trade for multiple reasons. It closed below the 5 EMA after reaching at least the 65 RSI level. We went from 70, above 70, to closing under 70. We also closed below the previous bar's low. So I have a lot of rules to completely exit the trade that have to do with the 70 RSI, 65 RSI, and the 5 EMA. Those all triggered on the day that I got out. So I got out here at 326.59. So the remaining shares that I took off closed for a gain of 13.8%. So that was very good example, everyone, of starting with a very good risk to reward ratio. Look, my end of bar stop was here. My entry was here. Very small. And it turned into a really big outsized gain. So very happy for that. Very grateful for that. But I am out, although Apple did have a big update today. All right, last on deck is Walmart. So I entered Walmart here on the 2nd of July at 111.81. Multiple signals here. Previous day, we closed below the order block. We closed back in the order block. Primary signal by itself. Previous day, we closed under the 300-day moving average. Next day, we closed over the 300-day moving average. Again, deep dip by signal, primary signal. Previous day, we closed under 30 RSI. Next day, we closed over 30 RSI. So we had multiple signals, deep dip by signals and order block signals. So I entered here 111.81. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. The next day was down, was below the 300 during the day, but I wait until the end of the day. It closed back above, kept me in the trade. Next day up, profit target. Next day up, profit target. Next day down. Next day up, profit target. Next day up. Next day just got to trailing stop level. And then at the end of the day, closed below a previous bar's low. What did I do? I had to sell half of my position. Next day down, next day up, profit target. Next day big up, sold multiple profit targets into that strength, thankfully. And then we headed straight down. And then here on the 21st, I closed below the 300-day moving average, which was my end of bar stop. And so the remaining shares that I had on the Walmart trade, I lost 1.3%. But of course, I didn't, excuse me, I didn't lose really 1.3%, did I? Because I took advantage of selling into partial profits into the strength, and then I exited half the position here with a close below the previous bar's low for a gain of 1.66%. So again, another example of really why it's important for me, at least, to sell, take profits when I have them, and to have a plan and a process that tells me what to do. So got out here for a loss of 1.3%. Next couple of days down. Today back up, actually starting to look interesting again. But out of those. So I am now out of Disney, which had a loss of 4.6%. I am out of Apple, remaining shares gained 13.8%, and Walmart loss of 1.3%. So those are all the positions, the current open ones and the ones that I closed, why I got in, why I got out. So anyway, hope that is helpful for you to get an idea of how I look at trading and how I manage my positions going forward. Okay, let's spend just a couple minutes on trader psychology. Very important, everybody. It's the most important skill in trading. I'm 100% sure of that. The ability to create a plan and then to actually follow the plan. This post came from Stephen Goldstein. You can follow Stephen at AlphaMind 101. He has a great podcast where he interviews all different levels of traders, retail traders, all the way up to major, large hedge funds and large financial institution traders. And I was lucky enough to have been interviewed on his podcast twice. And so please follow him at AlphaMind 101. Stephen's a very famous trader, very famous trading coach. And so when he posts something, I always read it. I always find it valuable. So let's see what Stephen has to say today. The profit paradox. If you chase the money, you lose the process and eventually the money. If you master the process, the profits take care of themselves. Great traders keep their eye off the scoreboard and focus on the play. 100%, everybody. It's just a strange thing in trading. If you focus on making money, somehow, some way, I don't know how it happens, but you actually usually end up losing. But if you focus only on your process, laser beam focus on following your process, not worrying about the gains or the losses, the strange thing is that's generally how you make money. And anybody with any trading experience knows this, and they would hear this and go, oh yeah, that's true, it's true, it's true. But listen, it's so true that you should really take it seriously. If you focus on the process, if you learn a process, if you focus on the process, it doesn't mean that every trade's going to be a winning trade. Of course not. You're going to have losing days, losing weeks, losing months. But in the long run, if you have an edge in your process and you follow it, the math is on your side and you're more likely to be a long-term profitable trader. But if you focus on making money, the trading gods don't like it. I don't know, but Stephen's right. If you chase the money, you lose the process. And if you lose the process, now your edge is gone and you're going to lose the money. So if you master the process, the profits take care of themselves. Great traders keep their eye off the scoreboard and focus on the play. It's 100% right. So thank you, Stephen. Appreciate that. Hope that was helpful for everybody. And now let's turn our attention over to the potential trades for next week. So I have here 7 potential entries for next week. Now, it is possible that all 7 of these could trigger on Monday. Unlikely, but it is possible that all 7 could trigger. Does that mean I would take all 7 trades? And the answer is 100% no. I only take 1 trade per day per time frame. And so if all 7 of these symbols trigger on Monday, I am going to have to take 7 legitimate signals and narrow it down with a fine-tooth comb and find the best one. So how do I do that? So I give each setup a quality score. For example, if it has 1 entry signal, maybe I give it a score of 1. If it has 2 entry signals, I give it a score of 2. If one has 3 entry signals, I give it a score of 3. And most of the time, I'm going to pick the one with the highest score. But there are situations where maybe it has 4 signals, 5 signals, but the risk to reward is not good. Well, then I have to take some points off of that, and maybe I don't even take the trade. I also look at higher time frames. If I'm trading the weekly time frame, if I'm trading the daily time frame, I may look to the weekly time frame to see if I can find something on the weekly time frame that give it some extra bonus points, maybe a rejection of a key level on the weeklies. I also look at relative strength. In other words, maybe the market's down, but one particular stock is up on the day. Well, that it had relative strength compared to the rest of the market. So this is how I do it. This is how I trade. This is how I teach my students to do it. And if I could just take a couple minutes and just put in a quick little plug to let you know what I do. I teach people all over the world. Um, I have taught for almost 10 years now. I love to teach, and I have a 20-hour course where I teach my students on a one-on-one basis. I don't teach in groups, I just teach one-on-one with my student, and we study 2 hours per week for 10 weeks. So it's a 20-hour course, 2 hours per week for 10 weeks. I teach you all of my strategies, all of the rules. It's very important that my students succeed. So I put a lot into the lessons. I always bring 110%. And if you become my student, I will teach you everything that I know. And when you are done, you will know a lot more about trading. I will teach you very good trading processes with good risk to reward ratios, and you will have a skill that you can use the rest of your life. And so if you are interested in becoming my student, I'd love to have you as my student. Just send me an email. My email is in the link of this YouTube video, and we can start the process. The course, the 20-hour one-on-one course is $2,000. So I know it's a lot of money, but I think, you know, if you talk to my students from the past, I am sure that they will say that was money well spent. I think it's worth every penny. So please send me an email and we can get the conversation started, and love to teach you everything that I know. Real quick, secondly, if you like online video courses, I have a really good online course that's at udemy.com, and the link is in the description of the video, where I teach you the deep dip buy stock trading strategy. It's just one strategy, but it's a really good video course. It's 9.5 hours, and I've sold so many of those around the world. So that's a really good place to get started, and that's quite affordable. It's between $30 and $50 usually for that course, and I've had so much good feedback. So either the 20-hour one-on-one course or the online course, all the description or all the information is in the description. So anyway, thank you for letting me put in my plug, and let's get back to business and take a look at the stocks that I am looking at next week. The first one is FedEx. So I've been kind of stalking FedEx for a few weeks, really, because we have this order block here, and I have not yet taken the trade. And really what I am looking for at this moment, I'm looking for FedEx to come into the order block. You can see it happened here, it happened here, it happened here. And every single time I got into the order block, it bounced, but it didn't really offer me a good risk to reward ratio. I didn't like this setup, but what I am looking for at the moment is I'm looking for a rejection of this 250-day moving average. You can see this is the purple line inside this order block. I love when there's major moving averages inside an order block. It's a key level within a key level. So the 250-day moving average is currently 303.13. We're at 314.96. So, who knows if it's going to get there next week? I mean, odds are it probably will not. But if it does, I want to be prepared and have the levels that I'm interested in. So next week, if we reject the 250-day moving average, I would certainly consider entering this trade. In addition to the 250-day moving average inside the order block, we have a megaphone trendline situation. Here's a swing low, followed by a lower swing low. We connect those swing lows. We bring the trend line out into the future. Do you see how the trend line and the 250-day are kind of gelling and coming together right about this area? So that gives me more confidence that if FedEx does come down to this area, to take the trade, because it's a confluence. It would be a rejection of the 250-day moving average inside the order block, possibly a rejection of the trend line as well. But this is just in my opinion, this is the interesting area. If it even gets there, it may just take off from here and I'll miss it. But if it does come down into this area, the 250 area, this trend line area, I'm certainly going to watch it closely and consider taking the trade. IWM. All right. I've been watching this chart for a long time. I've talked about it for the last 3 or 4 weeks, but we do have an order block here. We have a swing low, we have a swing high, we have a lower swing low, we have a market structure change. It defines the order block. Now, I put in my own key level. There's no moving averages in here, but I did put in my own key level here at 284.30. This is the green line. Why did I put the level in here? It has to do with this bar here on the 9th. We have this V1. When you have V1s or V2s, the number 2 bar halfway of the washout bar tends to hold some Fibonacci support. So this is the level that I'm keying off of. I don't know if it's going to get there, but if it does and comes down and rejects that key level there, 284.30, I would consider taking the trade. As long as it closes, if I take the trade and it continues to close above that level, I'll stay in the trade, take partial profit, so forth and so on. If it closes below that level, I'll simply be out. That is my line in the sand. Interestingly enough, this level, 284.30, also dovetails with the negative third ATR channel. About 92% of prices stop going down, move sideways, or bounce when they get to this level. So it's a nice kind of overlay confluence of two levels, the 284.30 level, which is halfway of the V2, and the negative third ATR channel together inside the order block. But this is a good example. I've been watching this chart. I haven't taken any action on the chart. Why? Because it hasn't got to where I want it to get to. But if it does, I will certainly consider it. Southwest Airlines, LUV. All right, well, Southwest had a big, huge move up when when oil went down, but now that oil's going back up, we are seeing the opposite, which is to be expected. There's quite an easy trade to see here on Southwest Airlines. It's the 200-day moving average inside the order block. Now, it's still quite a long ways away from there. I don't know if it's going to get there, but if it does, that's where I want to take the trade. I just don't get into trades unless it's going to where I want it to go. And this is ideal for me. This is a 200-day moving average, 41.16 inside the bullish order block. If it gets there, rejects the 200, I'll consider taking the trade. If it doesn't get there, it just moves up, fantastic. Great for everybody that owns love, right? But for me, I want a rejection of the 200-day moving average inside that order block. Currently, 200's at 41.16. Tesla, oh boy, look at this. Look at this sell-off, everybody. My gosh, tremendous. I didn't even measure. I mean, we had that swing high back on July 1st. Yeah, it's moved down almost 28%, basically straight down. But we are coming into some key levels. We have an order block from the past, green box, and we have a long-term trend line. It's a long-term trend line. It's a megaphone trend line. And so if we zoom out, swing low, followed by a lower swing low, connect the dots, the slope of the line moves out into the future. More times than not, in my experience, when you get to the third touch, that's generally you're going to get a reaction there. Not always, but more times than not. And that megaphone trend line, the third touch of that megaphone trend line would happen inside the order block anyway. So, we rejected the top of the order block today. Maybe that's it. It heads back up here and I miss it. But if it continues down, rejects the bottom of that order block or rejects that trend line, I would certainly consider taking a trade on that. And that's about around the $300, $302 level. So that's still, $11 lower. But anyway, it's deeply oversold. We're in some key long-term trend line levels and some key long-term order blocks from the past. So that's what I'm looking for. So I can't really tell you exactly right this moment because I don't obviously know what it's going to do, but it's basically rejection of 302 would be the rejection of the order block, or a rejection of about 299, 300 would be a rejection of the bottom of the order block. United Airlines, of course, very similar to Southwest Airlines. We have a nice, well-defined order block here that started back on the 10th of June. We have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change. Defines the order block here on the 10th. You can see the move up in hindsight, was this smart money buying here? Yeah, it was, clearly, because it went up. So now I'm waiting for the price to come back down into that previous smart money area. I don't know if it's going to get there. If it does and it rejects the 200-day moving average, which is 104.97 today, I would consider getting there. It may just take off from here and I miss the trade. But if it does continue lower and rejects that 200, I would consider taking the trade. My stop, my in-bar stop will be a close below the 200. If it rejected the first 100, that would get me in. Close back below the 200 would get me out. Oil. Okay, so this is interesting trade. You can see I have a red box up here. This is a bearish order block. Okay, so you can see we got to the bearish order block and we rejected it today. I did not get short today, but what I'm looking for at this point, you can see we rejected the bearish order block, which doesn't surprise me, but we also had what is called a bearish order block, meaning we gapped up, very bullish. Friday, we gapped down. So a sudden shift in sentiment from bullish to bearish indicates to me in general that in the future you will be lower. Doesn't have to happen. Just in my experience, it happens more times than not. I did not take the short today. What I am looking for, everybody, is I'm looking for a rejection of the bottom of the abandoned baby that I highlighted in blue. The low of this bearish abandoned baby should be some significant resistance. The low is 138.14. So next week, if we do reject the bottom of that order block, meaning we touch it, go under, or we go above it and close back below it, 138.14, I will certainly consider taking a short position because it's an abandoned baby. I, again, on the short position, will place a 2 ATR stop above, which equates to a 1% loss, and a 4 ATR profit target below, which would equate to a 2% account gain. So that's what I'm looking for. That's how I'll manage it. The 2 ATR stop, the 4 ATR profit target. But before I enter the trade, I want a rejection at the bottom of that abandoned baby at 38.14. All right, last but not least, everybody, is VIX. All right, so VIX's measure of volatility. We had an bullish abandoned baby here on the 15th of July. We gapped down, followed by a gap up, which indicates in the future you're going to be higher. Was it right? Yeah, it was right, for sure. Moved up strongly, moved back down, big move up, was down today. Similar to the oil trade, look at the abandoned baby. On a bullish abandoned baby, the high of the abandoned baby is the key support level. You can see we gapped up, we came down, we touched it, closed above, rejected here on the 22nd, tested it, moved up from there. So this is the level that I'll be looking at, 21.48. Right now we're at 22.36. So next week, if we do come down, reject that 21.48 level and close back above, I would consider getting long VIX. And again, because it's abandoned baby, this will be a bullish trade, 2 ATR stop, 4 ATR profit target above. So that's what I have for you for next week. If you have any questions about anything I mentioned in the podcast today or about any of these particular potential trades, please put them in the comment section. I'll do my best to get back to you and answer your question. I hope you have a really good rest of your weekend. I have a baseball game early tomorrow morning at 9 o'clock. I think that should be illegal. I think that's too early for baseball. But anyway, I'm excited. Love to play baseball. We're getting near the end of the season, so hopefully I'll get a hit. I'm going to do my best. But, I always like to leave off on the podcast. If you have the chance to go out and do something nice for another person today or any day, just do it. It doesn't have to be a big thing. If we all did one nice thing for another human being every day, it just would make the world a better place. And certainly it's clear. I think we could use a little improvement. So I have this small little podcast here and platform, but I at least try to spend a few minutes and try to put something positive out. Just try to go out and do something nice if you can for another human being. You like it when people do it for you, so why not pass it forward and do something nice for another human being. I'm a big animal lover. I was raised with a lot of animals, very close. And listen, if you have the opportunity to do an act of kindness for an animal, whenever that opportunity arises, do it. They appreciate it just like we do. So anyway, thank you if you've made it through this far on the podcast. I hope you learned something. I hope you found it valuable. If you did, again, if you hit the thumbs up button, that would be great. But I really hope you enjoy the rest of your weekend, and God willing, I will see you next week. But thanks again for stopping by. Thanks, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.